Hello, it's your financial friend Maggie. Welcome to the Inside Out Money podcast. Hey, Andrew.
Hey, Maggie.
How are you?
Good. I feel like I just saw you.
You did. I had the pleasure of getting to spend in-person time with you this week, which we rarely get, even though we live only 30 minutes away.
I know. It is kind of silly.
It sadly feels further than it is.
Well, and also, you had never been over to my house before, which was kind of crazy.
This house, I had
right?
Never
This
been
house,
to, yeah.
right? So that was great to hang out. We had beautiful weather. We sat out on my nice new deck that we've talked about a lot on the show.
Expensive deck. It was very nice. And on your free deck furniture that you got for free, that was
from
also
from
lovely.
a neighbor. Yep.
Yeah, and we both didn't get bit by mosquitoes, which is living the dream.
Very rare in Atlanta.
Okay. For those of you who might not realize where you are, hello and welcome to Inside Out Money. This is a personal finance podcast focused on redefining wealth from the inside out. Every week I speak with a rotating set of co-hosts about a different financial topic focused on helping you improve your financial mindset and tactics. Today we've got co-host Andrew here, and we're actually going to answer a listener question or a listener suggested episode, which is, what is rebalancing and should I be doing it?
Yeah, this is a good topic. We have not really touched on this at all on the show. So
we haven't. So big shout out to the listener who suggested this as a topic. They very nicely were like, have y'all talked about rebalancing much? I don't think you have. I would love an episode. And I was like, actually, that's a great gap.
And FYI, we love listener suggestions on episodes. You know, sometimes Maggie and I can bounce back and forth on like, well, what should we talk about? What are the topics? And we've got a couple of different lists, but anytime listeners suggest something, it's always good. So
yeah, because we want to talk about what you want to hear about. And every now and then we do get suggestions where I'm like, it's not really we're not the best people to talk about it, right? And so those I do try to sometimes I get less excited about, but this is in our wheelhouse. So it's kind of in our wheelhouse, but also not in our wheelhouse in a way, which we'll get into in a minute. So let's talk about this, right? This is the can you leave your low-cost index funds on autopilot forever? Or should you be rebalancing them, right? And rebalancing is the process of getting your investments back in line. So if you want 60% in U.S. stocks, 10% in international stocks, and
5% in cash.
Yeah, 5% in cash and 20% in bonds, whatever you might want, that's going to change over time based on how things perform. And rebalancing is the idea of getting things back in place.
And I think if you think about it as, well, what's my investment strategy overall? And a lot of that is defined by allocations. You know, your strategy is defined by your allocations and your percentages of allocations into those at different asset classes, and then rebalancing. So you have your strategy on one side, then you have the execution and actually what is happening and the evolution of your portfolio over time. And the portfolio can, quote, get out of balance again in relation to the overall strategy that you have. And so that's essentially what we're going to talk about.
Yeah, and I think that's a great point, Andrew, to separate the strategy from the execution, because the reason we haven't talked a lot about this is because the strategy that you and I happen to follow, and that I wouldn't say every one of the co-hosts follows, but definitely you and I, is we're pretty heavy in U.S. stocks, and we're okay with that. So we don't have a lot of rebalancing needs. But if your strategy is you want a very fixed percentage, you're aiming for a particular percentage of stocks, bonds, cash, etc. And some people are, and some people very much prescribe to, there's all sorts of recommended math of what your percentage of bonds should be based on how far you are from retirement. There's so many different schools of thought. We're not even going to get into that, right? That is not where, we'll talk about the ideas of that, but we're not going to give you a recommendation on that.
Yeah, and we shouldn't. And we probably should have had a disclaimer at the start of this, right?
Let's do a disclaimer.
Let's do a disclaimer,
Andrew.
Right? So we are not financial professionals. We are just two people on the internet having a conversation, and you should definitely seek out professional financial advice when thinking about investment strategies or specific recommendations on individual investments that you would make.
Yeah, they can give anyone a microphone, and we have given ourselves, anybody can buy a microphone, or not even buy a microphone and make a podcast. So yeah, we are not professional financial advisors. And Andrew, you did that disclaimer off the cuff very nicely.
Thank you.
From memory, I like it. It wasn't even in the notes. But I like your point of separating the strategy from
Yeah.
the execution, because rebalancing, I think for this discussion, it is just worth reiterating that we're not going to get as much into the strategy piece. We're more talking about if you prescribe to some strategy and some investment mix, then yes, you should be rebalancing. And so let's talk about rebalancing, and then we can kind of talk about whether you should be doing it or not, which does go to the strategy piece. So like I said, we're going to talk about both pieces.
Yep.
That was a joke because I said it like both ways. Okay. Should we start with why the concept of rebalancing even matters?
Yeah, so different asset classes are going to have different performance over time, and so you may have an asset class that's doing really well, and you may have another one that's doing really poorly. And so if your strategy is to have 60% in U.S. stocks and 40% in international, but 100% in stocks total, and your international stocks had a phenomenal couple of years, but your U.S. stocks had some really poor performance. And over time, that 60, because your international stocks outperformed your U.S. stocks, that percentage would gradually go closer to 50-50 or even flip itself. And you may have your portfolio be at 60% international, 40% U.S., just based off of the performance. And so if that was not what your strategy was going to be, then you would need to do some rebalancing to pull that back in line, which would be, hey, I need to sell some of my better performing assets, your international stocks, and then move more into your US stocks to get that strategy back in line with itself.
Yeah. So I think in the, why you would do this, right, is like we said, if you have a very specific target allocation based on whatever your risk tolerance is, whatever you believe it should be, then you would do this to get things back in line over time. And, we'll talk a little bit later about how often you might do it, but specifically, like Andrew said, it is literally like selling off some of your, if you started with 70% stocks and 30% bonds, to oversimplify it, and now you're at 80% stocks and 20% bonds, you would sell off 10% of your stocks to get back to, say, I'm oversimplifying it here, but that's the basic concept. And so this isn't about like making more money. It's really about managing your risk. And it is a very disciplined way to keep a particular asset allocation, a targeted asset allocation, if that is your priority and that's what you want to do.
I think what happens is people can sometimes put themselves on autopilot, and if you're not paying attention to this, then over an extended period of time, call it a decade, your actual portfolio allocations can look very different from where they started. And you've changed your investment profile and it can go both ways, right? You might have an investment profile strategy that is much more conservative, but over time, if your aggressive investments performed really well, that suddenly your portfolio can have a much higher risk profile than maybe what you're comfortable with.
Yeah.
And so that's where, and this is, I encourage everyone to pay attention to be actively involved in their overall investment strategy and approach, even if they're working with a professional, right? Knowing how things work is I think always beneficial. And so at least looking at this at minimum annually, but even on a quarterly basis, we just finished up Q3. It's October 1st as Maggie and I are recording this. So welcome to Q4 already in 2025.
Happy net worth tracking day.
There you go. And so, looking at this on an annual basis or a quarterly basis, I think is, I think probably, I'm not necessarily sure you need to be rebalancing quarterly. I think just keeping an eye on it quarterly is good.
For the average person, I would say, I can't think of it would be an incredibly high net worth individual or very unique. I even with them, you'd argue. Yeah.
So doing this annually, and some people will do it on a calendar year basis. Some people will do it on a milestone basis.
You could do it on your birthday.
There you go.
If that's exciting. Some people that would be the last day they want to do it if you don't find rebalancing fun. Someone like Andrew might be like, this is my birthday present to myself. I get to do a fun financial activity. Speaking of like how often, Andrew, I think it's worth addressing a point that I often think about, especially when it comes to rebalancing. So you have heard, I think myself and Andrew did the episode about financial planners. Or no, maybe that was Liz and I. Do you remember?
No, it was you and I. that we did. We did the financial planner episode.
Okay. So I've never been a big fan of financial planners. It's one of the things that I get like real fired up about. Again, for the average person, right? I think their fees are high. I think it's good. I love the Personal Finance Club's content on Instagram they've got some really great visuals of how much that 1% to 2%, sometimes more closer to 1% often, of how much their management fee can eat into your profits and your results over time, or your performance over time, I should say. And so I'm not a big fan of that. I think most people can do this themselves. But I will say this is where a financial planner will sometimes unnecessarily sell you on why it's so complex and why you need them to do it. Because look, if they're rebalancing, like they're going to be like, oh, I'm rebalancing for you quarterly. And like, you wouldn't want to take that on yourself. But that's our point of like, even if we were trying to manage to a specific target allocation, I wouldn't rebalance quarterly. That's way more than is necessary. Right? If I was talking to someone who is managing this stuff on their own, I would say check it out annually and make some decisions about how you want to rebalance. Be careful about capital gains, other stuff
and actually
short-term, focusing on long-term, not short-term capital gains.
That's probably the biggest caveat when it comes to rebalancing is the tax consequences of it. And so you can trigger capital gains very easily and quickly if you're doing rebalancing. And so it's always best to be doing rebalancing in tax-deferred accounts. And so inside of your IRA or your 401k, you can make those moves and have no tax consequences. But if you're looking at a taxable brokerage or a after-tax account, then you definitely have to pay attention to those the potential capital gains that you may trigger with that.
Yeah, and I think it's worth noting also that there are also, in addition to financial planners, there's services like, when I used to use Wealthfront as an example, and I used them for investing, it was the very first investing I did, is you go through a whole intake and they kind of come up with your risk tolerance, and they're essentially getting you to a target allocation, and then they're basically robo rebalancing it for you, right? There's not an actual person who's individually managing your portfolio. They're doing it at scale with computers, and so one of the biggest things they are marketing to you is their rebalancing, which again, they're charging a meaningful fee for. So if you want to pay for that, there are people that will rebalance for you, but you're going to pay for it.
And then that also gets into the target date funds, which you and I have talked about quite a bit on here. I mean, the target date funds are essentially an auto rebalancing program. Now, the reason why Maggie and I are not a huge fan of target date funds is because they're typically very conservative in their allocations, and so they more recently they have pretty significantly underperformed the market. Now that's in an up market, right? In a down market, they may outperform, but in general, a lot of them will put, even in somebody in their 20s, will put 10% into bonds, right? And so they're typically just more conservative than what I think would be advisable.
Yeah. And again, we're not going to give like financial advice to each of you because we don't know your situation. But if I was guiding my 20-year-old, I would not tell them to put 10% of their money into bonds. So, and I don't have 10% of my money into bonds, and I'm 45. So take that as my opinion for whatever that means. So Andrew, I'm curious how you would answer this question, because I have always believed, and I'm going to kind of maybe state this wrong, but I have always believed that owning index funds in general, which, to clarify, a like S&P 500 or a total stock market index fund basically tracks whatever it's titled for, right? It might track the overall total U.S. stock market, or it might track just the S&P 500.
or the S&P 500 index, right?
Yeah. And so I always think of those as having a bit, it's not actually rebalancing is not the term, right? But to me, those are automatically rebalanced for me in the sense of how they are managed. Would you agree with that statement?
I would
comparable.
Nah, I would disagree with that, because you're still talking about a single asset class.
Yes.
US stocks, right? And so
rebalancing implies changing up your asset
class. So when we're talking about asset classes, we're talking about, stocks is one asset class, but then a subclass of stocks is international versus domestic, or large cap versus small cap. But still, stocks is kind of that big pool. And then you have things like real estate. You have things like bonds, right? precious metals, right? Gold, foreign currencies. So there's all these other types of asset classes, private equity, right? Angel investor, like all the like high risk capital, right? Lots of different. But I mean, the most common ones we talk about a lot are stocks, bonds, cash, real estate,
and U.S. stocks versus international stocks.
Right? Yeah, all those. But yeah, all the different asset classes. So, so VTSAX is all stocks.
Yeah, but don't you think it's like rebalancing large cap versus mid cap versus small cap? That's kind of what I was.
It includes every single stock. Now, one thing that people have talked about is when you look at the VTSAX or the S&P 500, that the high flyers, Amazon, Google, Meta, NVIDIA, Apple, the high flyers have, over the last couple of years, done so well that they are now overweighting the index essentially. And so if you look at the S&P 500, that you're actually concentrating more of your dollars in a fewer number of companies, and people have highlighted that as a risk.
Yeah.
Which is I mean, there's no way getting around that when NVIDIA is a couple, I think they're up to like 3 trillion in market cap, something absurd, right? Apple, you're going to be concentrating more in those in those fewer companies, even though you're in an index.
And so I think like those index funds, which we are big believers of, and we've got whole episodes where Andrew and I talk about, why we invest in index funds and even which specific ones we invest in. Essentially, it's low cost total market or, S&P 500 style index funds. Those are, it's called, they're market capitalization weighted, right? Which means the proportion of the fund invested in a stock is based on the company's total market value. So the automatic part of it is if one stock's price goes up relative to another, its weight in the index or the ETF or whatever automatically increases as a percentage of the total fund value, right? And or vice versa if it goes down. And so that's kind of Andrew's point where, some of these big tech stocks now are such a big proportion because they're such a big proportion of the overall stock market. They've been, automatically weighted into a bigger portion of the index funds that we own.
Yeah, I always like going in my Vanguard account and just looking at VTSAX and what makes it up. Yeah. And you can see the percentages of how much it is. Actually, I'm just going to pull up.
And you can see the percentage that the top 10 are. It's big.
Yeah, so...
Yeah, NVIDIA is 6.5%. Microsoft is 6%. The top 10 holdings of VTSAX are 32.99%. So I'm going to round up to 33% of total assets today. That'll vary, as it's as the market weighting changes.
Yeah.
Okay. When I like to go back to the listener specific question, what is rebalancing and should I be doing it? We talked about what it is. Let's recap the should I be doing it and your perspective, Andrew.
Yeah. So my personal approach, I've talked about this a lot, right, is that we are 100% invested in VTSAX or an S&P 500 index fund in my 401k because VTSAX was not offered, but we're in the Fidelity S&P 500 fund. And so our approach, and my personal approach, not a recommendation, just my personal approach has been that at my age, 47 years old, that over the last decade, I have been willing to take a much higher risk profile because I'm taking a long-term approach with an extremely long horizon. And so I'm comfortable with the ups and downs. And, if the stock market dropped 30 to 40%, would I be okay with that? Yes, I'd be okay with it. It would not be ideal. And I've gone.
It's not going to feel nice.
It's not going to feel nice, but I've gone through a number of dips and I have weathered that storm. And so I feel confident in my behaviors as well, that if the market dropped 30 or 40%, that I wouldn't be rushing to the doors to sell. And so now that philosophy may change a little bit as I move from a accumulation to a decumulation phase, having left my corporate job recently. I think over the next decade, will my risk profile and tolerance be different from the last decade? Yeah, most likely it will be. And so while I have been 100% invested in VTSAX, that approach and strategy may change. And I think that I'm certainly open to it. Where I sit today, I'm still comfortable with where we are. When I say 100% in VTSAX, we also have a cash position that we have built up over the last couple of years in order to mitigate sequence of returns risk. So if you look at the total portfolio, it's not 100%. Within our stock portfolio, it's 100%, but we have cash reserves to mitigate sequence of returns risk for the next couple of years.
And I'm very similar to you, other than I have some leftover stuff from when I was with Wealthfront and they were automating the target allocation for me. And it was much more diversified in the sense of like, I was stuck with a bunch of like international stocks and some bonds. And I don't want to pay short-term capital gains or even long-term capital gains right now. And it's a smaller percentage of my portfolio. So I've left them in there, but that's just to mitigate, taxes that I'd have to pay on them if I move them. Now, when it's within my 401k, again, it's a non-taxable event. So or an IRA, so I don't have to worry about that. But in my brokerage account, I've chosen to keep some of those things that were kind of grandfathered in to mine. But on the flip side, like Liz doesn't want all US stocks. She wants some international stocks. That's great. I wouldn't sit there and argue someone out of that approach if they feel good about it. And so I think the bigger thing back to the strategy piece, Andrew, that you started with is you need to feel good about your own risk tolerance and what if having a percentage of bonds and matching some sort of target allocation that you heard from somebody or that you like feels good to you, go for it. You've done 90% of the hard work just by the fact that you're saving and investing, and like the exact allocation is something you should feel very comfortable with.
Yep.
And not something that you should do because Andrew or I told you to, or a certain financial planner told you to. You need to feel, do your research and you need to feel good about it. Okay, so let's just recap and wrap up what we just talked about in this episode. This is going to be a shorter episode, which we hear some of you guys like, so you're welcome. Some people really like the long episodes. In that case, I'm very sorry. Go listen to another episode of Inside Out Money. There's lots of them to listen to. The practical steps to rebalance, like you don't need a complicated degree to figure this out. You don't need to be a financial planner. Like it's not that complicated. The first step is you've got to know your target. So like we just talked about, like you have to have some sense of what you want your asset allocation to be, right? That is the foundation for your entire plan. We've talked about what ours is. Once you know what that is, you want to then go check what you currently are at. So if you want to be at 70-30.
And that's also across all of your accounts. That's something that some people will forget. They'll only look at it within, two of their accounts and not through all of their accounts.
Yeah, they're not looking at you got to add up all your accounts.
Everything.
You got a Roth
Total
IRA.
Net worth, right.
Like I've got where I have, I've got a Roth IRA, I've got an HSA, I've got a brokerage account, and I've got a deferred compensation. I have asset allocations that I've had to choose in all 4 of those accounts. So to do this right, I need to go look at it across that spectrum.
And also, one thing we haven't talked about is real estate, right? A lot of people have got home equity, and so you automatically are in the real estate market if you have home equity, right?
And again, in that asset allocation, you might be, often people are just thinking about what they have in the market or what they, have in terms of invested versus they're not necessarily thinking about a percentage of real estate. But when I look at my total net worth, I do look at what percentage of it is in the market, what percentage of it is in real estate. So you want to, you need it, like we're big fans of actually tracking your net worth. You want to know where you have all this money sitting and what it's in. And you want to look at, like, you need to like log into your accounts and look at what's actually in it and double check them every now and then and see where you're currently at. And then you want to take that to figure out how you're going to rebalance. You can rebalance with new contributions that you're putting in, right? If your percentages are off, you might already be planning on investing some new, extra money you have available to you, or you might actually need to sell some things off, which again, you want to be careful about where you are triggering taxable events or not. And you might want to sell stuff off. You might want to reinvest your dividends in something else. So there's a bunch of different ways you can do that. And you just want to think about how you plan on doing that rebalancing. So I'll give you a good example of that. When I had all this stuff I moved over from Wealthfront, when I was using their auto asset allocation that they provided, I moved it over to Fidelity. I had more international stocks and bonds than I wanted. I changed the settings in Fidelity so that those dividends paid out as cash to me instead of were sold off. instead of automatically reinvesting back into that stock because I didn't want more international stock. So I'm at least slowly divesting my international stock because of me turning off or changing how my dividends were paid out. So when I get those dividend payouts now as cash, either way I was taxed on it, I am actually rebuying VTI with it, which is very similar to VTSAX. It's what's available within Fidelity. And so that's one example of how you can do rebalancing versus just selling and buying stuff.
Good point.
Okay. I think we did it, Andrew.
Yeah.
Okay. Well, thank you all for listening. Thank you to the listener who suggested this topic. I hope we've answered your question. We always appreciate you all spending some time with us. If you've enjoyed this episode, we'd love it if you want to leave us a written review on Apple Podcasts. It helps other people to find the podcast. We really appreciate it.
We also encourage you to share this episode with a friend or family member to encourage ongoing discussions about money. You can also subscribe wherever you listen to podcasts. If you have thoughts or questions, we'd love to hear from you, and you can leave a voicemail or text us at 404-981-3370 or hit us up on Instagram.
Awesome. Thanks, Andrew.
Thanks, Maggie.
Bye.
Bye.